My name is Drew, and if we haven't met before, welcome to ReadyBudgetGo. I'm glad you found your way here. If this isn't your first visit, welcome back. It's always good to see you again. This is My Money Relaunch, a series where I talk about all the steps I took to take control of my financial life after I dug myself out of debt for the second time. Before we go into today's topic, there's a couple points that I need to cover. First, I'm not a financial advisor. This series is for informational and entertainment purposes only. Before making any moves with your money, do your own research and seek your own counsel. Second, while I'm talking, I will be putting down stickers in this paint by sticker book. For each sticker I place, I will save $1 toward one of my big goals. Currently, I'm working on replenishing my emergency fund. If you missed last week's episode, I discussed why my emergency fund is taking a $4,500 hit. Whether you're watching me try to make the most of my limited fine motor skills by putting stickers down, or you're just listening to me talk, I'm glad you're here. And now with all that out of the way, let's jump into today's topic. If you've been watching this series from the start, then you will know that I've been covering what I call the STRIVE method, which stands for saving and spending, taxes, retirement, insurance, investments, and estate planning. Each month in my finances, I focus on one of these areas. I've covered the process I went through for the first couple cycles, but after that, your finances really become more individualized as you start reaching benchmarks toward your own goals, which will be different from mine. As such, I intend to use this series to talk about money-related topics that are on my mind or on my heart. Each will relate to at least one area of STRIVE in one way or another. This week, I want to talk about ethics. Specifically, how do you know whether you're dealing with an ethical person when you discuss your finances with a professional? And what exactly are ethics as it relates to personal finance, and who gets to decide what is ethical and what is not? I'm going to answer the last question first, and the answer is it depends. Most people you work with to plan major life events, everyone from financial planners to investment bankers to doctors to funeral directors, are governed by a board or similar body that decides what is ethical and proper for the people in their profession. In some cases, board certification is a requirement to practice. This is especially true in the medical and legal fields. In finance, it's true in some areas, such as insurance, and less true in other areas, such as certain banking functions. It's a bit striking that in general, the first person you speak with at your bank or credit union about your financial needs is generally the least qualified to help you. Later in this episode, I will talk about how I vet financial professionals, but first let's make sure we're speaking the same language. Often, people confuse ethics with other adjacent terms, such as legal and fair. Many actions can be legal according to the letter of the law, but not ethical. Let's say one day, out of the blue, your boss fires you. No matter how many times you ask for an explanation, you receive no answer. If you work in an at-will state, this is perfectly legal. It's not very ethical, but it doesn't violate the letter of the law. Or if you've ever been ghosted by someone, whether in your personal life or your professional life, it's not always the most ethical thing to do, but it's not illegal. Of course, there can be extenuating circumstances here, but I think you get the idea. So what are ethics anyway? Simply put, ethics are a set of moral principles that apply to a specific group of people or their actions. The ethics of a particular group may not always align with your ethics. I once worked for a company that put out an employee survey every year. It was quite lengthy, and one of the questions it asked was whether employees believed that the company was ethical. They scored very badly on this, much to the shock and horror of management. But management didn't define what they meant by ethical, so people made their own interpretations. At this point, we were still coming out of the Great Recession, and many people had gone without a raise or promotion for several years. Others were formerly part of a much larger work group and were now juggling multiple additional responsibilities without an increase in pay or title. After the results were published, we were told that the company meant by ethics, or what the company meant by ethics. Their definition had to do with things like whether the books were all above board. They were asking if we thought the company was doing anything illegal, not whether we felt we were being treated fairly. But again, without any guidance, people made their own inferences. In the same vein, sometimes when things feel grossly unfair, people will tend to extend that to the realm of ethics. I was one of the people busting my butt at my job while my 20s slipped away without a pay increase. Years later, I discovered that the reason I and everyone else on my team weren't getting a raise is that the company was not earning enough profit and was, in fact, leveraged to the teeth. This was in the wake of several high-profile acquisitions the company had made, all of which had been financed with additional debt. When many of these acquisitions failed to pan out, the company wrote down the value of what it had paid for those companies. There simply wasn't any cash left in the till to pay us more. To me, the fact that the money was borrowed and then spent on bad acquisitions is not unethical, as I don't believe it was done in bad faith. What's unethical is not being honest with employees about why raises were not available. That left a bad taste in many people's mouths. But let's bring it back to finances. There are several key components that constitute the definition of ethics as it relates to financial professionals. First among these is fiduciary responsibility. I've talked about this in other episodes, but to briefly recap, a fiduciary is someone who must act in the best interest of the client, even if that has a deleterious effect on their own compensation. For example, let's say you're talking with a financial advisor about your investment strategy. You want to know about a specific mutual fund that you have had your eye on. The advisor may be able to earn a large bonus if they push you to a different fund that pays commission to stockbrokers. This commission is called a load. But if that fund does not meet your goals, the advisor is ethically obligated as a fiduciary not to steer you toward it, since it serves the advisor's interests more than your own. Another aspect of ethics is transparency. This covers everything from publishing their fee schedule to disclosing any conflicts of interest that may exist or arise, and talking with you openly about how they derive their recommendations to their clients about what to invest in or how much insurance to carry, and so on. They should also be able to have a frank discussion with you about risk. I steer clear of any financial professional who is dismissive of my questions or concerns, or who responds with arrogance or any kind of disrespect. As always, I'm a big proponent of doing things for myself, but sometimes you do need an expert, and I have said goodbye to lawyers, insurance agents, accountants, and funeral directors whom I felt were not being open with me, because you should be able to ask questions and receive responses that are not evasive or incomplete. And that brings me to the next facet of ethics, which is competence. Look, the world is full of nincompoops and quacks, and they are in every profession. Just because someone has a doctorate or other fancy credentials does not mean that they are omniscient or infallible. Every year, colleges and universities confer degrees upon people who have not grown their knowledge one iota in all the time they spent taking classes. That said, the financial world is very heavily regulated, and it's important to know that the people you are entrusting with your money are at least up to date on what they need to be doing. It's not uncouth to ask someone about their educational background or to look into their credentials. This isn't foolproof, but it's one way to make sure that the person you're working with is at least putting in some effort and cares enough about their profession to remain current. Enrolled agents, who are people the IRS qualifies to do other people's taxes, have to recertify every 3 years. The date for this is determined by Social Security number. But tax laws change every year, so make sure they're aware of the most recent changes to the tax code if you work with one. Last but not least, there's confidentiality. If you worry about your personal information being stolen, ask the person you're working with or wanting to work with how they safeguard client data. If you don't get a good feeling from their answer, walk away. That brings me to how I evaluate financial professionals. I've touched on this a little bit already, but first and foremost, your best guide is your gut. If somebody is giving you the ick for any reason, cut bait and find someone else. You are never under any moral obligation to work with anyone. If a restaurant serves us a bad meal, why would we go back? Yet there are countless people out there who stick with financial professionals despite the fact that they either don't like them or don't trust them, or both. What's with that? I read somewhere once, and I wish I could cite the study, that in terms of brand loyalty, banks are second only to cigarettes. It makes sense when you think about it. I've had the same checking account since I was 16, despite some shady practices by the financial institution. But it's my money. Moving it is a hassle, so I stay unless I have to. When the big banks cut savings rates to near zero, I did move my savings account to another institution with better rates, but it was a drag. Next to your intuition, the best thing to look at is their level of experience. People who are fresh out of school should not be handling client accounts on their own. Often they're paired with someone else who has been with the firm for many years or are in some other kind of mentorship program. It's not wrong to insist on working with someone who is seasoned. It's not ageism, it's about experience. As your financial life evolves, you may find that you are handed off to someone else when your advisor or broker retires, is promoted, or moves on to another field. This has happened to me a couple of times, where my account is part of the book that is handed to a different advisor. I try to give them the benefit of the doubt. So far, I'm 50-50. The first time it happened, which was with my insurance broker, I stuck with the new one. The second time, which was my accountant, I shot my business and found a different one. The third thing I do to evaluate the relationship, whether the relationship is a good fit, is to monitor for gaps in communication. I'm an active participant in my finances, and if the person I'm working with is always unavailable, doesn't return calls, or is slow to respond to email, that is a big red flag that it's time to move on. If they don't value my business enough to give me the time of day, what entitles them to keep it? I'm not talking about calling them every week, but with the Strive method, everything comes around at least twice a year, which is more than a reasonable frequency to check in. If I had more hours in the day, I might do it every quarter. Lastly, and this is especially true for anyone you have partnered with on an investment or retirement account, assess whether you're getting a good value for your money. The first part of this is understanding how they are paid. Fee-only advisors take a portion of your assets under management each year. Anyone charging more than 1% of assets under management is gouging, in my opinion. The theory is that they're incentivized to make money for you, since growing your assets also grows their commission. But even if your investments shrink, they will still take that 1% fee or whatever their rate is, albeit of a smaller number. Commission-only advisors don't charge you an upfront fee, but they're paid by the purveyors of the financial products they purchase on your behalf. Loaded mutual funds, annuities, some insurance policies, all of these generally have commissions. I would avoid someone who earns money only by putting my hard-earned cash into expensive investment vehicles. As a general rule, investment vehicles that pay a commission to the person who's selling them are good for the financial advisor, bad for the client. It's not truly universal, but it's true most of the time. Fee-based advisors are a little bit of both. If you go with a fee-based advisor, understand which products they sell that come with a commission and be very clear about whether or not you want any of your money in those. Ultimately, evaluating a financial advisor is up to you. There's no magic formula here, and some of it is more of an art than a science. Always remember your gut, first and foremost. It won't steer you wrong. Okay, that's all for this week. Next week, I want to talk about hype. This is something that I have been thinking about a lot lately, as the stock market's been on a tear and some pundits are warning of an AI bubble. But I also want to talk about it in the sense of other fashionable money trends like meme stocks and the runaway world of sports betting and prediction markets. When the hype gets high, it's important to keep your focus and your head. I hope you'll join me. For now, if you enjoyed this episode of My Money Relaunch, please be sure to give it a thumbs up, leave me a comment down below, and subscribe if you're new. And until I see you in the next one, take care.